Welcome back to Goodwill Wealth Management. Today, we have a fascinating topic to discuss that's essential for anyone interested in finance and investing: the yield curve. Let's start with the basics. What is the yield curve? Well, the yield curve is a graphical representation of interest rates for a range of maturities on a set of fixed income securities. In simpler terms, it shows you the interest rates on bonds of different durations. But why is it so important? The yield curve is like a financial crystal ball, providing insights into the economy's future. By looking at the shape of the yield curve, you can gain valuable information about where the economy is heading. For instance, it can signal economic growth, recession, or even inflation. Yield curves can take on various shapes, and each shape tells a different story. There's the normal yield curve, the inverted yield curve, and the flat yield curve. Let's break down what each of these shapes means. Normal yield curve. A normal yield curve is typically upward sloping, which means that short-term interest rates are lower than long-term interest rates. This shape indicates that investors expect the economy to grow steadily. Inverted yield curve. In contrast, an inverted yield curve is when short-term interest rates are higher than long-term rates. This is often a sign of an impending recession, as it suggests that investors are worried about the near-term economic outlook. Flat yield curve. A flat yield curve, as the name suggests, is when the interest rates for short and long-term bonds are nearly the same. This shape can signal uncertainty or a potential economic slowdown. Now that you understand the basic concepts, let's talk about how to use the yield curve. Predicting economic trends. By keeping an eye on the yield curve, you can make informed predictions about the direction of the economy. For example, if you see an inverted yield curve, you might consider adjusting your investments to prepare for a potential recession. Investment strategy. Investors often use the yield curve to develop their investment strategies. For instance, in a normal yield curve, they may opt for longer-term bonds for higher returns, while in an inverted curve, they might prefer short-term, more secure investments. Timing interest rate decisions. The yield curve can also help in timing decisions related to interest rates. Central banks, for example, may adjust their monetary policies based on the yield curve to manage inflation and stimulate economic growth. In conclusion, the yield curve is a vital tool for understanding the economic landscape and making informed investment decisions. By keeping an eye on the different yield curve shapes and their implications, you can better prepare yourself for the financial challenges and opportunities that lie ahead. If you found this video helpful, don't forget to give it a thumbs up, subscribe to our channel, and hit the notification bell to stay updated with more financial insights. Thanks for watching, and we'll see you in the next video.